Good afternoon, everyone, and thank you for joining us this afternoon to discuss Fall Federal Small Business Programs, a primer for government contractors. My name is Peter Ford. I'm a partner with PilieroMazza in the Government Contracts Group, and with me today is my colleague, Lauren Brier, who's an associate in the GovCon Group. Many of you know about PilieroMazza, but just a quick recap. I mean, we are a business law firm dedicated to servicing the needs of government contractors and commercial businesses. We have a great corporate group, L&E group, litigation, but what we're most well known for and what our bread and butter is government contracting. And within government contracting, small business government contracting, which is a lot of what my practice focuses on, as well as Lauren's. So today, the topic is really small business related. We're talking about the SBA's and the VA's programs that have been implemented to give certain companies a quote-unquote leg up in terms of going after work, in terms of set-aside contracts and sole source contracts. So we're going to be discussing the programs themselves, the regulations that govern eligibility criteria, and the benefits that you can get out of the program. We'll talk about size and affiliation, because that's really a key component to all of these programs, is that you have to be small. And then we'll get into the specific programs themselves, the 8A program, the SVB program, the WomenOwned program, and the HUBZone program. Please, if you have any questions, you should be able to just type them in. And then we're going to try to leave 5-10 minutes towards the end so that we can field any questions. And if we don't get to your questions, there is a way that we get a printout of every question that was inputted, so we will get back to you at some point. You can go to the next slide. So these are the regulations from the FAR and the CFR that we'll be talking about today. And again, like I said, these are the regulations that govern the various SBA and VA small business programs. They address the basic eligibility requirements for program participation, continued eligibility criteria, program benefits, etc. I believe copies of the slides will be made available to you guys, so I'm not going to read you through all of them. Freddie, you can go to the next page. So this is the small business program. And what I mean by that is here we are just talking about small business set-aside contract opportunities only. But like I said, a key component of being a participant in any of these programs is that you be small. So the information on this side really applies across the board when it comes to qualifying for some of these other socioeconomic programs. Small is contract specific. So when an agency issues an RFP for a small business set-aside, the CO assigns a particular next code to it. And that code has its own size standard. It can be revenue-based or employee-based. And to be eligible to bid on that RFP, you need to be small under that size standard. So how do you determine whether you are small or not? Well, for revenue-based size standards, it's based on your company's receipts or revenues as reported on your federal tax returns. And specifically, it's your average annual receipts for the past 5 years. It used to be 3 years, beginning a 3-year average, 3-year look back, but Congress changed it to 5 years through the Small Business Runway Extension Act because of the timing and the implementation of SBA's regulations. Concerns now have until January, I believe, 6 of 2022 to use either a 3-year average or 5-year average to calculate their size, whichever works best for them. But after that, it's going to be a 5-year average across the board. For employee-based size standards, it's your average number of employees over the past 12 months, and that's both part-time and full-time employees. And importantly, in calculating your size, you need to account for the revenues or employees of any affiliates. And I'll explain a little more on that in just a moment. When is size determined? The general rule is that you must be small as of the date you submit your initial offer, including price, so it's a specific date. Some of these affiliation rules kind of tweak the general rule. For example, and I'll talk about this, a sensible subcontracting rule, that analysis is done not at the time that you submit the bid, but at the time of your final proposal revision. You can go to the next slide.
I'm going to jump in here. And,
what is it?
Oh, I'm sorry, Peter.
Yep.
So when discussing affiliation, what is it? So a small business concern size is aggregated with the size of its affiliate. So when you're looking for affiliation rules and how they apply, they can be found at 13 CFR section 121.103. And it basically lists the unique SBA rules that apply to affiliation of a small business. So like the slide says, some affiliation is apparent, where parent companies and sister companies are deemed affiliated, but most affiliation rules are not as apparent. Some of these are exemplified in the bullets here, but the first one is like the present effect rule. So under the Small Business Administration's present effect rule, a letter of intent could create affiliation between parties negotiating like a potential sale or merger. So whether or not a letter of intent in fact creates an affiliation is often a fact-intensive inquiry. But some of the key considerations that are taken into account are the negotiations taking place, circumstances surrounding due diligence, and as a practical matter, the language of the letter of intent. Another thing they'll look for are familial relationships among owners and managers, economic dependence in the 70% rule. So what is that? SBA can presume affiliation based on economic dependence if the concern in question derives 70% or more of its receipts from another concern, and that's over the previous 3 fiscal years. So that's how SBA can determine affiliation under the 70% rule. Another thing they'll look at is whether there's multiple common investments between the companies. The newly organized concern rule, it states that 2 companies are affiliated when 4 circumstances exist. So at a high level, those 4 are former officers, directors, principal stockholders, managing members, or key employees of one company organize a new company, whether the 2 companies are in the same or related industry, whether the individuals who organize a new company serve as its officers and directors, and the old company furnishes or will furnish the new company with contracts. So those are the 4 elements or circumstances that they'll look to determine affiliation. There's also the ostensible subcontractor rule, and then oftentimes they'll just look to the totality of the circumstances between the companies. One of the things that is highlighted as well is that there are exceptions for tribes, ANCs, and NHOs, so that's something to consider as well when determining whether or not a company is affiliated.
Yeah, and the one thing I'll add, and this goes back to what Lauren was saying about most of these rules are not black and white. Maybe there's a handful that are black and white, and most of them fall into what I would call the gray area bucket. But for example, on stock ownership affiliation, if an individual or an entity owns at least 50% of a concern's voting stock, that individual is deemed to control, and that's the end of the analysis, meaning it's not rebuttable. These other rules that Lauren, some of these other rules at least, that Lauren touched on, like economic dependence, that raises a presumption of affiliation that can be rebutted by showing, for example, that you're not overly reliant on a particular client, and namely because you're a new firm and you have maybe a handful of contracts, and like most new firms, you went to where the money was, and it just so happened to be with this particular contractor. You can also rebut it by showing that despite these contractual relations that you have with this particular firm, you are free to sell your goods or services elsewhere. Yeah, and the other thing I'll add is most of these rules, with the exception of, I think, present effect and ostensible subcontractor, they're what are called general rules of affiliation. So under the general rules of affiliation, if you're found to be affiliated with another company, 1, you could lose the contract award that was protested, but 2, you have to treat them as an affiliate moving forward. And until you fracture that affiliation, fix the issue which caused it in the first place, and go back to the SBA and get recertified as a small business, you can't go after any new work under the same or similar size standard. A sensible subcontractor rule, on the other hand, that's contract specific, where a prime and its sub can be found to be affiliated. And so since it's contract specific, that means you might lose the contract award at the end of the day, but moving forward, you don't have to treat this other entity as your affiliate.
So talking about the 8A Business Development Program, there are certain ownership and control requirements that are applied. The most important being that the company must be 51% owned and controlled by a socially and economically disadvantaged individual who is a U.S. citizen. Again, there are certain exceptions for this for tribes, ANCs, and NHOs. But what is ownership? It must be unconditional and direct. And there must be entitlement to dividends and distributions of the company. As far as what's the definition of control, it entails the strategic policy setting and daily management and administration of business operation. Other elements of control that are deemed appropriate, there's an example of level of managerial experience of the extent and complexity needed to actually run the business concern. And how the SBA defines social disadvantage, there is a rebuttable presumption for members of designated groups. Otherwise, the company must establish an individual social disadvantage by preponderance of the evidence. And the way that this is done is that individuals must show at least one objective distinguishing feature that has contributed to their social disadvantage. For example, this could be like race, ethnic origin, gender, a physical handicap, sometimes shown through long-term residence in an environment isolated from like mainstream society, personal experiences of substantial and chronic disadvantages in society, or sometimes it's also shown through like negative impacts on entry into the business world. And then how is the economic disadvantage defined? So if your net worth is not in excess of $750,000, or your 3-year average AGI is not in excess of $350,000, and your total assets do not exceed $6 million.
Yeah, and there are certain exclusions, because maybe at first blush those thresholds do seem a little high, and frankly they used to be much lower. But when you're looking at your personal net worth, or SBA is looking at your adjusted personal net worth, they account and back out certain what they call exclusions. So for example, any equity you have in your primary residence, any equity in the business itself, or any funds tied up in a legitimate retirement account, they're not going to count towards that $750,000 threshold. And when it comes to personal income, S corporations, for example, just based on the way that they're taxed, the tax obligation flows up to the S corp shareholders, who then have to pay the taxes personally. SBA realizes that, and what a lot of companies do is to cover that tax obligation, they'll take distributions from the company and then turn around and pay the IRS. So as to not penalize a company that is an S corporation, distributions that are taken and are subsequently used to pay taxes or otherwise reinvested in the firm, they're not going to count towards your income. But anything that's non-tax distributions, like distributions of profit, that's going to count towards your income in addition to any sort of W-2 wages that you have. And then total assets is just that. They look at your total assets as if they're unencumbered, and the only exception, the only exclusion that there is funds tied up in an IRA account. So yeah, getting into the 8A program, it's a certification. It's a full-on certification process. It can be quite cumbersome. It can take a lot of time, meaning people come to us and ask, I want to submit an application. I think I'm eligible. How soon can I get in? And the answer we frequently have to tell them is it can easily take 6 months. It could take a year. But once you're in, and you have a 9-year term. But during the course of those 9 years, or over this course of 9 years, you have to maintain your eligibility for program participation, meaning you have to remain economically disadvantaged. You have to make certain reports to SBA. And you can't suck money out of the company. I mean, you can to some extent, but this is a business development program. So what the SBA really wants to see is that the money that the company is generating on 8A contracts or non-8A contracts, the bulk of it is staying in the company, so that the company, once it graduates from the 8A program at the near young, it's not going to fail, essentially. And then, of course, the company has a disadvantaged owner or owners, and that individual throughout the 8A program term must maintain ownership and control of the company as required by SBA's regulations. Program benefits, the biggest one, and this is what really distinguishes the 8A program from all the other socioeconomic programs, are sole source contracts. You can get sole source contracts in these other programs, but it's much easier to get them in the 8A program because the SBA doesn't have to do an analysis to first determine that there's only one company that can provide this supply, this service. They can go straight to you and then go straight to the SBA and say, hey, I want to order $4 million worth of widgets, and I want to order it from this particular company. In other words, they can avoid competition altogether, which can be done to some extent in these other programs, but it's not, like the snap of your thumb like it can be in the 8A program. There are set-asides. There are 8A joint ventures. SBA used to approve all 8A joint ventures. They stopped doing that back in November, and now they only approve joint ventures, 8A joint ventures for sole source contracts. There's the SBA's mentor protege program, and this is a benefit that you'll see on other slides, but because it carries across all of the programs, it's not just specific to 8A. I mean, there's one small business mentor protege program, and it captures all of these socioeconomic categories. The biggest benefit is that you can joint venture with your mentor who may be large, and the joint venture would take on the 8A status of the protege. And essentially, you have a joint venture between a small business and a large business going after 8A work. So on the one hand, it allows the 8A firm to leverage the experience, past performance of its large business mentor, let's say. And from the mentor's perspective, they're going after contracts or getting a chance to go after contracts that they otherwise wouldn't qualify for, simply because of their status and size. It is 9 years, it's 2 stages. Developmental stage is years 1 to 4. Transitional stage is years 5 to 9. Again, you got to remain compliant the entire time. And in my experience, where firms get tripped up is much more so in years 5 through 9 as compared to years 1 through 4, just because there are some additional reporting requirements, and there's a rule that basically says once you get into year 5, we want to see that you're actually going after non-8A work, so that you're not just reliant on the 8A program for your survival. So there's some additional requirements that kind of kick in at that stage. And in my experience, the companies that are in years 5 through 9 are just scrutinized more closely by SBA. But again, you got to maintain eligibility the whole time. You can go to the next slide. So the SDVOSB program, and I'll say this, if you can understand and grasp the rules for the 8A program in terms of not affiliation, but ownership and control, then that's the most complicated program. But the ownership and control, they basically apply across the board. So similar to an 8A firm, an SDVOSB must be 51% owned and controlled by a service-disabled veteran. Ownership must be unconditional and direct, which is exactly what Lauren was saying about the 8A program. And that simply means that, one, you can't own an 8A firm through a holding company. You have to own it directly. And 2, it has to be unconditionally owned. And what that basically means is you are, for example, a member in an LLC, you're the disadvantaged owner and it's an 8A firm. You can't have any sort of restrictions on your ownership interest, meaning they want to see that the governing documents allow the disadvantaged owner to transfer his or her ownership interest to whenever he wants or she wants, and whenever she wants and he wants. Lauren touched on control again. It's the basic day-to-day operations and the long-term decision-making. I'll add that some of the other requirements are that the disadvantaged owner, in this case, the SDV, be the highest compensated individual, the highest ranking officer, have managerial experience, need to run the company. And then how do you prove that you're service disabled? You either have a valid disability determination from the DOD, or you have a disability rating from the VA. Either one of those would allow you to self-certify as an SDV-OSB, assuming that you comply with all the other ownership and control requirements. Next slide. So, and this is kind of a hard pill to swallow for minority investors. It still is. It's gotten a little bit better, but under the SBA's rules, the SDV owner of a limited liability company, for example, has to control every single company decision. And until recently, all literally meant all, meaning you couldn't have any sort of provision in your operating agreement that the SDV owner couldn't satisfy on his own and take that particular action. SBA realized this, meaning the fact that, minority investors were not all too attracted in investing in an SDV firm if they really had no control, no say whatsoever over the company's operations. So a couple of years ago, they added what's called the extraordinary circumstances exception. And as you can see here, and this is straight from the regs, there are 5 specific extraordinary circumstances that the SBA and the VA, because the VA follows SBA's rules, allows a minority owner to have veto power over. But it's just this. It's these 5 and no more. So it's adding a new member, dissolving the company, selling the company, merging the company declaring bankruptcy. And again, these are the things that, having the veto rights over is any sort of investor that's coming in. These are the typical types of rights that they want to have veto power over to protect their investment. But what's not on there, for example, is amending the company's governing documents, meaning amending the LLC's operating agreement, which, again, I'm not sure why that did not get put into this list, but it's pretty significant. If you are entering a relationship with an SDV and you're going to give the SDV basically full unfettered control over the company, and that control and how it's going to work is spelled out in the operating agreement. By the same token, the SDV has a unilateral authority to amend the operating agreement and change it as he or she wants. So again, it's maybe at some point in the future this list will be added to, but for now it's 5, and I'd rather there be 5 than there be none, which wasn't the case too long ago. For non-NonEA work, it's a self-certification process. What that means is that unlike the SBA's 8A program, there's no formal application that has to go into the SBA. And instead, it's really just self-certifying in SAM. I will say that Congress late last year agreed to eliminate self-certification for SDV-OSBs and adopt a government-wide SDV-OSB certification. Why would they do that? Well, I think the general consensus is that they saw a lot of fraud in companies self-certifying as an SDV-OSB, and that started going unchecked, and companies getting access to SDV-OSB set-aside contracts when they very well may not even have an SDV owner. So the program is going to be more formal like the 8A program, hopefully not as formal and as cumbersome as the 8A application process, but it's not going to be implemented immediately. SBA has 2 years, so roughly 2022, but time will tell how long it really does take. Maintaining eligibility, like the 8A program, you got to be small, and you got to be small under your primary NAICS code, which is the code which essentially is assigned to or represents your largest chunk of revenue. got to maintain ownership and control. You have to submit yearly information into SAM regarding your self-certification. And then the benefits, there are set-asides like there are 8A set-asides. I touched on the Mentor Protege program. So essentially, I mean, if you're a company that qualifies as an 8A and you just so happen to also qualify as an SDV and a woman-owned small business, then any joint venture that you do with your large business mentor would take on all three of those socioeconomic statuses, meaning you and your large business mentor could go after 8A contracts, SDVOSB contracts, woman-owned small business contracts, HUBZone contracts if you have that too, which obviously is a huge advantage and greatly improves your ability to compete. Like I said, there are SDVOSB set-asides, there are SDVOSB joint ventures. SBA a few years ago made the joint venture rules for each of these programs basically uniform. So there's a number of things that need to be, for example, in an 8A joint venture agreement that also need to be in an SDVOSB joint venture agreement. And if it's not in there, you're running the risk of violating the regulations and you could be found ineligible for award. Access to sole source contracts. Again, this is a benefit here, but unlike the 8A, they have to go through an analysis and first determine that there's only a single source, which is not how it works in the 8A program, where I said, essentially, the contracting officer can pick you and go to the agency and say, I have an 8A, I have an award I want to make through the 8A program. I want to sole source it, and I want to sole source it to this company, and you can completely avoid competition. So everything that we were talking about so far in terms of the certification process, how it works, and how you maintain your eligibility, it was kind of more focused on non-VA work, meaning non-VA SDVOSB set-asides. If you want to go after contracts that are VA set-asides as an SDVOSB, things are a little more complicated. There is no self-certification, but rather it's a full verification process, which can take several months to go through. And then after you're verified and you're listed in the vendor information pages as an eligible SDVOSB, every 3 years thereafter, you have to go through a re-verification, which in my experience can be just as painful as the initial verification. And there are also rules that allow the CVE, the VA, to remove a company from the VIP database. So for example, if they find out that you've submitted false information, then that's a basis for them to remove you. If you're the subject of an SBA size determination and you're found to be large, they can immediately just pull you right out of the database and you're out until you either fix the issue that made you large or you file a successful appeal at OHA reversing that decision. SBA, it was weird a couple of years ago because the VA for CVE had its own ownership and control rules, and the SBA for its for its self-certification program had its own rules. And for the large part, they did mirror each other, but there were small nuances that applied in the SBA that didn't apply in the VA and vice versa. That has all changed now. And so when it comes to ownership and control, SBA's rules govern, meaning when SBA or the VA is processing a CVE verification application, they're processing it under SBA's ownership and control rules. And lastly, VOSB set-asides, currently at least, they're not outside of the VA. I mean, if you want to go after VOSB set-aside work, you have to go after VA VOSB set-aside work, which means you have to go through this whole process of getting verified by the CVE. And when I say whole process, I mean it's providing CVE with a number of documents to demonstrate eligibility, just like you would for the 8A program, tax returns, personal financial information, governing documents. It's not that difficult. It's not that difficult to navigate. It's more of a pain than anything else, an administrative burden. But yeah, I mean, we help companies navigate these programs and if there are issues that we need to address to fix their eligibility or make sure that they're eligible, we can certainly do that.
Okay, so talking about the Women-Owned Small Business Program and the ownership and control requirements that apply there, the company must be 51% owned and controlled by one or more women who are U.S. citizens. As we've discussed before, the ownership must be unconditional and direct here as well. There's no express requirement for entitlement to dividends and distributions here. As far as control, it entails both the long-term decision-making and the day-to-day management and administration of the business. So, for example, the woman must hold the highest officer position. Sometimes we have clients that ask, must the woman be most highly compensated? The regulations do not require that explicitly. So there's nothing in the rules that says that needs to be in place. There are additional requirements for economically disadvantaged women-owned small businesses. Here, they must be 51% unconditionally owned and directly controlled by one or more women who are economically disadvantaged. And there's also net worth requirements, which cannot exceed $750,000. As for the 3-year average AGI, cannot exceed $350,000, and then total assets cannot exceed $6 million. And then as far as maintaining eligibility within this program, you must be certified by SBA or an SBA-approved third-party certifier. And to maintain that eligibility, the company will have to remain small, maintain their ownership and control requirements that were referenced in the previous slide. And for EDW OSBs, the woman owner has to remain economically disadvantaged. There also has to be annual representation made to the SBA as far as your program eligibility, and a new program examination is performed every 3 years. There are significant benefits being within the WOSB or the EDWOSB program. As far as available set-asides and sole source contracts, there are only certain NACE codes, and these are readily available on SBA's website. But as far as the NACE codes, there are 83 NACE codes that are designated as eligible for contracting under the WOSB program, which is a significant benefit. 45, I believe currently, there are 45 NACE codes in which WOSBs are underrepresented, and there are 38 NACE codes in which EDWOSBs are substantially underrepresented. Other benefits, and this kind of goes to what Peter talked about previously, if you're within the WOSB program, you also have the ability to be in the SBA Mentor Protege program and engage in WOSB, EDWOSB joint ventures. Another program that we're going to talk about is the HUBZone Program, which stands for the Historically Underutilized Business Zones. And this program helps small businesses in urban and rural communities gain preferential access to various procurement opportunities of the federal government. And as far as ownership and control requirements here, it must be at least 51% owned and controlled by U.S. citizens. There are some exceptions for tribes, ANCs, and NHOs that apply here as well. Ownership may be direct or indirect. As far as control, it entails both the day-to-day management and long-term decision-making authority for the HUBZone concern. There are some other requirements that apply here. Again, these can be found on the SBA website, but the principal office must be located in a HUBZone. 35% of the firm's employees must reside in a HUBZone, and the firm must attempt to maintain having 35% of its employees reside in a HUBZone during the performance of any HUBZone contract it receives. So what does this mean? This means that the business is permitted to slip below 35% without withdrawing from the program and without losing a contract awarded to it under the program. However, the business has to make a good faith effort to return to this 35% number. So examples of this are posting advertisements, holding job fairs, and so on. But the SBA plausibly could decertify a HUBZone firm that really is making only half-hearted efforts to regain its 35% residency status. So it's really important that if you see yourself falling below this 35% requirement, that you have documented evidence that can show that you're making the effort to bring this number back up. A firm must meet all eligibility criteria as the date of their most recent certification or recertification with SBA. So as far as maintaining eligibility and program benefits of the HUBZone program, you have to get certified by the SBA. And to maintain your eligibility, you want to make sure that you're remaining small as far as size, and maintaining ownership and control in the principal office in the HUBZone. There are certain exceptions to this that are identified in the regulations. You want to attempt to maintain a 35% requirement, which I discussed previously. And you must undergo a full program re-examination here every 3 years as well. There are significant benefits of being certified within the HUBZone program. There are various HUBZone set-asides available. You can engage in the SBA Mentor Protege program. You have the opportunity to engage in HUBZone joint ventures. There's significant access to sole source awards, and you also get a 10% price preference for full and open federal contracts here as well.
Yeah, and thank you guys for attending, and we'll go through the questions. I do want to say that this is really a high level overview of these small business programs. I mean, we could, for example, Lauren mentioned demonstrating social disadvantage where you're not a member of a presumed group. I mean, that entails crafting a narrative with specific examples of discrimination, and we could teach a whole presentation or do a whole presentation on that. So just something to keep in mind that, we condensed a lot of information into 19 slides. So if you have any other questions, follow-up questions, or any questions about what we may have just ran through pretty quickly, we're happy to field them. I'll just start going. So and just so you know, yes, the slides will be available. We have a number of questions about that. Is there any reason a large prime contractor couldn't do a set-aside award for a small business? Well, I guess they could come in as a joint venture partner / mentor and get access to the prime contract. They could come in as a subcontractor. But I guess just because you're large under one code doesn't mean you're necessarily a large business across the board. So you may be large under a consulting next code, which prevents you from going after small business set-aside consulting work. But you may still be small under a construction next code. So you can be large and not large at the same time, if that makes sense. Does an 8A firm have to maintain the 750 net worth for 9 years? Yeah, it's all 9 years. And again, we do work with clients who are bumping up to these thresholds, and it's kind of a matter of where do you put the money, because sometimes it gets a little circular, meaning you can put money into excluded assets, but when you do the total assets test, all of that money is going to get considered. So to some extent, you can manage your net worth and where your assets are going and how much money is attributable to excluded assets, which I think, and this kind of raises a good point. If you get into the 8A program, understanding these rules, just the economic disadvantage rules and how much money that you can withdraw out of your company, is not something that your everyday accountant is aware of. So one of the things that we would recommend is once you get into the 8A program, you need to have not just legal counsel, but you need to have a solid CPA who can help you track these numbers for all 9 years. And there are a number of resource partners that we work with that can do just that. I know it might be an added expense, but it's an expense that's worth it to get the full 9 years at the 8A program. Personal income is also something that you can track. I mean, you can, and you have to be $350,000 or lower for the full 9-year term, but that's really just your compensation. So if you have to take less money, you take less money. The one that really trips people up is total assets. And this again has a $6 million threshold, with the only exclusion being retirement accounts. And the situation that comes up a lot is you have a single owner 8A firm that starts doing gangbusters in the 8A program, but the 8A rules require that individual to keep basically all the money in the company. So now the company is just so cash heavy that if you're looking at his total assets or her total assets, and you have to account for the equity in the company, I mean, it can easily push you over $6 million, within year 3, 4, or 5 of the program, if not sooner. So that's one that's a little more difficult to, track, so to speak. But the other two, as long as you have a good accountant, you should be able to navigate. Is a spouse of a service-disabled veteran still qualified? The vet is deceased. Yes, there's what's called the surviving spouse rule, which basically says that if a service-disabled veteran dies as a result of his service-connected disability, or that veteran has a disability rating of 100%, and upon his or her death, the ownership of the company goes to the spouse, then that spouse can continue to run the company as an SDVOSB for as much as another 4 years. I mean, there are some situations where if she gets remarried or he gets remarried, you're going to lose that status. And I will say that's really just those two limited instances when it kicks in, meaning whether you die as a result of your disability or you have a 100 disability rating. Not a lot of people meet that or are going to meet that. But I can tell you that through the 2020 NDAA, they're modifying the regulation. It's not in the regulations yet, but the NDAA is the NDAA, so it is law. But under the new rule, you could either be a surviving spouse the way that I described, or if you're just an SDV and you just you pass away for any reason whatsoever, and your ownership goes to your spouse, then your spouse can run that company as an SDVOSB for a 3-year term. So again, that's something that's technically law, but it's not in the regulations, SBA's regulations right now, but we are keeping a lookout for it. Can you explain what it means to be a similarly situated entity? Is it problematic if the contract is awarded on a set-aside basis and after award to large business, subcontractors' costs exceed what was expected, throwing off? Yeah, so I mean, this is, again, something that applies across all of these small business programs. If you get awarded a set-aside contract, you are expected to self-perform a certain amount of that work. So if it's services, you got to do 50%. If it's construction, you got to do 15%. If it's specialty trade, you got to do 25%. But a few years ago, and what that means is there's only so much work that you can subcontract without violating the limitations on subcontracting rule. SBA a few years ago did create this concept, so to speak, if you want to call it the similarly situated entity rule, which essentially allows a small business to subcontract to another small business on a small business set-aside contract, and the work that small business subcontractor is performing will count towards the self-performance requirement of the prime contractor. But it's got to match exactly. Meaning, if it's an 8A firm subbing to just a small business without 8A status, they're not similarly situated. And how do you determine if this the subcontractor is small? You would think it would be, all right, well, what does the prime contract say? It's a size standard, but that's not the case. It's the size standard applicable to the work that's being done in the contract itself. That's how, to be a similarly situated entity, at least qualifying as the small component of it, that's how it works. But yeah, I mean, if you could, in theory, if you're subbing to a similarly situated entity, you could subcontract out 99% of the work. Whether that would really fit well with the agency is another thing, just keeping in mind that they awarded the contract to you, and now you're turning around and subcontracting the entire portion of it to another business who they have no privity of contract with, obviously there's some risk to that. The non-manufacturing rule, can you explain the non-manufacturing rule? Again, this is probably a topic that could be a full presentation, but it essentially allows resellers of products to supply the end products of a US-based company. And so long as the reseller is primarily engaged in this specific business and they take ownership or possession of the product before it gets passed directly to the government, and in some cases it can get passed directly because of drop shipping, then you can supply the product of a small business, which is defined as 500 employees. And these limitations on subcontracting that we we're just talking about, they don't apply. Meaning there's no percentage of work that the reseller has to do. They just have to take ownership or possession of it or add something to it before it gets to the government for them to pass it along. So in a sense, they can be viewed as pass-throughs, but I mean, they're not. I mean, they're not just calling up, large company A and saying, hey, ship this stuff directly to the government and here's your invoice. There's more to it than that. If I started the 8A process, now my daughter will be the primary owner of the company. What steps do we need to restart our application or change the information to? So do you want to address the issue now or address it after you get into the 8A program? I think it really depends where you're at in the application process. If you're close to the finish line, you may just want to go in with yourself as the disadvantage owner, and then when you get in, do a SBA 8A ownership change request so that you can make your daughter the 51% company. But that takes time, and it's never guaranteed that it's going to get approved. So if you're kind of more at the beginning of the process and you haven't provided everything under the sun to the SBA, then you may want to make the change now, just so that it's something that you just don't have to deal with once you get into the 8A program. Because once you get into the 8A program, the last thing you want to do is have to go right back to the SBA and provide them with all the documentation that you previously gave to them. But you could do it either way. Looks like we have one more. Of the 5, I'm assuming it means extraordinary circumstances, limited to SWSB JVs or other MP JVs too. Well, there's case law out there that says the general rules of ownership and control that apply to an SDVOSB, they don't necessarily have the same applicability when it comes to an SDVOSB joint venture. So there's an argument that those 5 extraordinary circumstances, they don't even come into play when you have an SDVOSB joint venture. Obviously, if there are other ways that they can find problems with a joint venture, such as where the non-SDVOSB partner to the JV has too much control, or the JV agreement doesn't otherwise comply with the SBA's regulations. But let's just assume that they did apply to just SDVOSB joint ventures. And again, I think there's an argument that they don't apply at all. It would just be for SDVOSB joint ventures. I know, and I can tell you that we've gone to the SBA with a joint venture agreement where we have, and this was when they're approving 8A joint ventures, where we have 10 things listed. And it's a little weird because every district office processes JV applications, or did at least, kind of in their own way. I don't know why it shouldn't be that way, but it was. So requirements from one SBA office may be different from another. But no, if you can demonstrate, at least with respect to most offices, that what you're putting in the JV agreement has nothing to do with the daily operations, meaning running the contract, and it's really more limited to these extraordinary actions that you would typically give veto rights over for a minority owner, then you can make a case that you should not have to take it out. But no, the 5 extraordinary circumstances, that's limited to the SDVSB program. So I think that's all of the questions. If I missed your question, I apologize. Our contact information is here. Like I said, feel free to email Lauren or myself, whether it's a follow-up to a question you previously asked, or if you have a new question. I mean, that's why we're here. So again, thank you all for attending, and I hope you enjoyed the presentation.